This is the untold story of how America's sharpest investors, the smart money, abandoned the market months before the greatest collapse in financial history. A story of secret meetings, strange movements, shadowy trades, and the biggest red flags Wall Street had ever seen. New York, 1928. The market was roaring. Stocks had doubled, tripled, even quadrupled. Newspapers told everyday people, "Buy stocks, they can only go up." Families mortgaged homes to invest. Taxi drivers gave investment advice. Shoe shiners talked about their favorite stocks. But beneath this gold-painted surface, something darker was forming. Old, experienced investors, the ones who survived the panic of 1907, noticed something strange. Companies had rising stock prices, but falling profits. Banks were issuing loans faster than ever, but the borrowers had weak financials. And the most dangerous of all, people were buying stocks with borrowed money. Margin debt exploded. The system was a tower built on a thin foundation. And the smart money could smell smoke. Late 1928, a secret pattern emerged. The same group of wealthy investors, men who rarely agreed on anything, quietly started selling. Not all at once, not in panic, but slowly, carefully, secretly, like men escaping a burning building one by one, so the crowd doesn't notice the flames. You could see it if you looked close. Big blocks of stock quietly sold at open. Heavy selling disguised by small buy orders. Insiders cashing out while the public kept buying in. Most traders ignored it. Most newspapers called it healthy volume. But the smart money wasn't waiting for headlines. They could feel the shift, a market rising not on strength, but on speculation. In early 1929, a small group of powerful financiers met at the Old Hotel, Pennsylvania. No reporters, no assistants, just men who controlled millions. One of them leaned forward and said, "The market is running on borrowed time. Get out while you can." Another added, "The public is buying blindly. We cannot save them." The decision was made. The smart money would exit, fully, before summer, before the storm. And so they did. But not everyone listened. A handful of newer wealthy investors, the ones who never saw a real crash, said, "This time is different. The market has changed forever." They mocked the old investors, called them cowards, said they didn't understand the new economy. For them, the market wasn't a risk. It was a machine that printed money endlessly. They stayed fully invested. History would judge them harshly. As 1929 progressed, the warnings intensified. Red flag 1. Strange banking behavior. Banks started demanding collateral more aggressively. Some stopped lending to brokers. This was a sign. They feared something big was coming. Red flag 2. Silent withdrawal of liquidity. The Federal Reserve grew uneasy. Interest rates crept up. Liquidity tightened. Insiders knew what that meant. Pressure, stress, fragility. Red flag 3. The smart money vanishes. By mid-1929, something truly stunning happened. The smart money was gone, completely out of the market. But ordinary Americans, they were more invested than ever before. The perfect setup for disaster. October 1929. The month that would burn itself into financial history. Prices wobbled, then fell a little, then regained, then weakened again. Small investors were confused. Newspapers said, "Nothing to worry about." But the smart money watched from the sidelines, silent and calm. They had already escaped. October 24th, 1929. The opening bell rang, and then chaos. A tidal wave of sell orders hit the exchange. Prices collapsed instantly. The ticker fell hours behind. Brokers panicked. People rushed to banks, begging to sell anything, everything. The smart money? They watched. They had sold their assets when prices were high. Now they were buying only one thing: silence. They knew the disaster unfolding was unstoppable. Over the next days, the market continued falling. Rich families lost fortunes. Ordinary Americans lost everything. Banks failed. Jobs vanished. The entire world economy shattered. People asked, how did this happen so fast? Why didn't anyone see it coming? But the truth was simple. Some did. But the world did not listen. The survivors of 1929 shared one lesson that must be remembered forever. When the market rises on debt, hope, and hype, that is when you should fear it the most. The smart money didn't have a crystal ball. They simply paid attention to liquidity leverage, insider behavior, banking stress, market psychology, and silence before the storm. When the red flags piled up, they acted. Not emotionally, not suddenly, just wisely. As the documentary fades out, the message becomes clear. History doesn't repeat, but it rhymes. Whenever people borrow heavily to invest, assets rise faster than profits. Banks act nervous. Insiders quietly sell. The public becomes. The 1929 crash wasn't a surprise. It was predictable, visible, and obvious to those who knew where to look. The smart money didn't escape because they were lucky. They escaped because they respected the cycle. They read the signs. They acted without fear of public opinion. And today, the signs still appear. In every generation, in every market cycle. The question is, will you recognize them? I'm the Market Man, and this was the untold story of the Great Escape before the 1929 crash. Stay informed, stay aware, and remember, markets reward the patient, but they punish the blind.